Sorry, Carolyn.
You guys have to be louder for me. Sorry.
Okay, no problem.
Forgive me, Stuart.
Okay, thanks everybody. So first on the agenda, people have had an opportunity to review the minutes.
I have read them. I have no objections. I move approval, assuming that what was stated in paragraph 9 was basically what Chair Halpern had said, and I believe that what he requested.
Yeah, I reviewed that, so I was okay with that. But if we have a second? I'll second. Okay. All in favor? Do we have any members of the public who have any comments?
Staff.
Okay.
Veronica Serrano. I just have a quick announcement.
I'm sorry?
Veronica Serrano for the record, and I just have a quick announcement as Sandag staff for the ITAC committee. The annual Form 700, or the Statement of Economic Interest, is due because of the holiday now on April 3rd. So in your packets I have provided a short form. If you wish to file on paper, you can also file electronically. And I do have the longer form with all the detailed instructions if the committee members care for that packet as well.
Great.
I have a question on that.
Yeah.
Is there any required ethics training? I just took one for another committee. Can that be just sent over and applied?
Yes. Yeah, I think it's required every 2 years, so if you just send us the certificate, then I think we can use the same one.
Okay. Is Sarah here to do a brief update on the environmental litigation program?
It's on consent, so.
I'm sorry?
It's on consent.
Okay. Well, did anybody have any questions, or did we want to hear the brief update? I guess if there are no questions, then Dustin, our environmental expert, is good.
Yeah, no, I move.
Okay, then we could, sorry. Thanks.
You're doing consent.
Ariana, your report.
Yes. Since your February meeting, the board held its annual retreat. 2 of your ITAC members, Brad and Stuart, were in attendance. There was discussion about next steps after Measure A, and that's going to be discussed further as part of Ray's data accuracy presentation later in your agenda today. Transportation Committee also met in February. They received a report on the proposed amendments to the ITAC term limits, which was based on your performance audit recommendations. That was supported by the Transportation Committee, and that's on your agenda for today as well. Then the Transportation Committee also received a report on the Transnet revenue revisions, which they recommended and the board approved. Comments on that item included direction for staff to more frequently provide updates on status of revenues going forward. You saw that at your February agenda as well. And then finally, at its February 24th meeting, the board also approved the Rtcip fee adjustment, which you saw at your February meeting. The board also approved the 7-point work plan, which is on your agenda today as part of Ray's presentation. The first reading of the proposed amendments to term limits for ITAC members was conducted, and then as I mentioned, that's on your agenda today as well. Last but not least, you heard from Keith Greer at your meeting last month, and that was regarding the EMP annual status report, and that was also presented to the board in February.
And I was actually at the board meeting, Ariana referenced, if I could just elaborate on one thing. The board specifically, even if they approved the moving forward with the 7-point plan, but they did specifically ask for ITAC feedback, if any, so hopefully people got a chance to look at the materials, and Ray's going to be going over that. So as we move through that part of the agenda, let's be mindful of the fact that there was a specific request for feedback, if any. Mark is here to talk about the audit.
Good morning. Get all my binders. So we have 2 items for you today that are related to the annual transit compliance audits. We have items 5A and B. So we're going to, as in the past, go through 5A first through completion, and then we'll just roll right into 5B. So one of the responsibilities of the ITAC is to conduct an annual fiscal and compliance audit of all Transnet funded activities using the services of an independent fiscal auditor to assure compliance with a voter-approved ordinance and expenditure plan, and that is per the ordinance. So the ITOC through Sandag has engaged the services of the Certified Independent Audit Firm of Davis Farr to conduct these audits using agreed upon procedures, or AUP, as you'll hear most often. So we have Mark Davis with us of Davis Farr. He'll be presenting the results of the fiscal year 2016 Transnet compliance audits. After his presentation and any discussion, then I'll provide the next steps of this process, and then we do have a recommendation for consideration of the ITOC. And with that, I'll hand it over to Mark.
Thanks, Lisa. Good morning. We met with the ITOC back in July of last year, and we talked about the agreed upon procedures that we were going to perform for this upcoming year's audit. We got your approval at that time of those procedures, and they result in just under about 50 procedures that we perform in all the various agencies. This year, as in years past, we performed procedures at 24 different agencies, including the 18 cities, the county, MTS, NCTD, Sandag, Caltrans, and ITOC. We conducted field work starting in about September of 2016 and continued all the way through December 2016. We did have a few follow-up things that happened in January, February, and that brings us here to today. There are 7 major areas that we look at in the procedures that you approve. The first area is expenditures. We'll go through those 7 areas now. The first area is expenditures. And with expenditures, we select a sample of agencies' expenditures and about 25% of their total expenditures to determine whether or not they are included in the Rtcip and that they are eligible costs in accordance with the ordinance. And for all agencies reviewed, we had no exceptions related to that. There are 5 agencies that are in the process of obtaining approval for transfer of funds between projects at the time the draft reports were issued. Those agencies are Caltrans, Carlsbad, El Cajon, Encinitas, and La Mesa. By the time we get to the approval of the final reports, we anticipate that all those approvals will have been obtained from the agencies. The second area we look at is the maintenance of effort requirement. And here, agencies are required to spend at least their maintenance of effort threshold that's established every 3 years. We look at their discretionary expenditures that they report on their annual street report to determine if they've met their MOE requirement. And all of the agencies, with the exception of the city of Lemon Grove, met their MOE requirement. Lemon Grove fell short by about $21,000 this year, and that item is going to be discussed in the next agenda item. The third area we look at is the 30% Sandag board policy rule, and here we're making sure that agencies maintain a fund balance that's no more than 30% of their annual apportionment. This year we had 4 exceptions. Escondido exceeded that by $1.3 million. La Mesa exceeded by $18,000. Poway exceeded by $23,000. And San Marcos exceeded by $278,000. Now, of those 4 agencies, only San Marcos is a continuation from the prior year. In June 30, 2015, they exceeded the 30% threshold by $830,000. They're spending that down. They're down to $278,000 now. In 2015, there were 4 additional cities that had excess fund balance and that have all exhausted that excess fund balance. There's no findings that are written related to this 30% balance. It's just that Sandag will withhold funding until they bring that fund balance down below that threshold. The fourth area we looked at is local street improvements, and here we're looking at revenue spent on congestion relief versus maintenance. We made sure that 70% of the revenues were provided or were used for congestion relief and no more than 30% used for maintenance for the year, and we had no exceptions noted with that procedure. And then last year we had a new procedure looking at cumulative local street revenue being expended for maintenance, and that over the life of the ordinance, that no more than 30% of funds received were spent on maintenance. We had no exceptions at all on for any of the agencies on that item. The fifth area we look at is the Rtcip funding. Here we're looking at that all the agencies are collecting the exaction fees in their approved amounts. We had no exceptions with that this year. Some of the other procedures we look at related to Rtcip are that fund administration. Are any of the agencies spending Rtcip funds on fund administration? And only City of San Diego spends that, and they were charged the 3%, which is the maximum amount. No cities have transferred, loaned, or exchanged their Rtcip funds, and no cities have granted developer credits in lieu of collecting their exaction fees. All of the agencies did provide their Rtcip information to us by the required due date of December 1st. The sixth area that we take a look at is in regards to transit operator eligibility. Excuse me. Here we are focusing on whether or not that the operating costs per vehicle hour for bus services or for revenue vehicle mile for rail services did not exceed the growth in the CPI for the year. This past year, just like in the prior year, CPI decreased by 8.17%. So that becomes a flat level that we look at, meaning that the two transit operators' growth in their operating costs needs to remain flat year over year. MTS was not in compliance with their rail operator eligibility. Their percent grew by, or their operating costs grew by 2.17%, so it exceeded that flat threshold, and that item is going to be discussed in the next agenda. And the final area we take a look at your direction is indirect costs that are allocated to the project. This past year we had 12 agencies that allocated indirect costs. That's up 2 from the prior year. There were 10 agencies in the prior year that allocated indirect cost. 3 of those 12 agencies do get their indirect cost rates approved by state or federal agencies. And the remaining agencies all have a methodology that is reasonable. We do have 2 agencies, the City of Carlsbad and the City of Chula Vista, where their information that they're allocating their indirect costs on, or they're basing their allocation on, is getting dated. Carlsbad last reviewed their information in 2013, but while we were in the field, they were undergoing a review, so they're bringing it current at that point in time. The City of Chula Vista last reviewed their indirect cost plan in 2012, which is based on 2010 methodology, so it's pretty dated. We wanted to bring that to your attention. The results of all of the procedures are included in individual reports for all the individual agencies, and those can all be found on Sandag's website. And we will be finalizing these reports within 60 days after the ITOC reports these findings to the Transportation Committee at their meeting next week. That concludes my report. I'm available for any questions you may have related to the AUPs this year.
Is there a limit on the amount of indirect funds that can be spent on a project? I mean, is it related to a percentage of the overall cost of the project, or I'm trying to get a handle on what's considered reasonable?
There is no limit that's allowed. If an agency charges indirect costs, they need to have an indirect cost plan. There's no requirement that that indirect cost plan be approved by any state or federal agency. As I mentioned, three of the agencies do submit their, that's Caltrans, City of San Diego, and Sandag, do submit their indirect cost plans to Caltrans or to a federal agency for review and approval. We do look at the methodology that the cities use and see that that methodology over which they're allocating indirect costs is reasonable, meaning that they're including all of their city funds in this allocation process, and not just singling out Transnet funds to receive all of their indirect costs, if you will. So we look at and also the basis of allocation, the manner in which the costs are being spread to those various funds or programs, again, from a reasonable standpoint. But I believe from an ordinance perspective, there's no cap on indirect costs.
Do we have any idea of the monetary amounts we're talking about for indirect costs?
We do have that information that when we conduct the audit. I don't have that here with me today. I'd be happy to provide you with an idea so you can see what the percent of indirect costs that were allocated to the program to total expenditures are. I'd be happy to provide that if you'd like.
Thank you.
In looking over your data, and I thought it was very excellent, thank you very much. I was struck by attachment B, compliance with 30% fund balance limitation, and particularly Escondido and San Marcos. Maybe I missed something, but is there an explanation as to why they have such an excess amount? As I understand this form, why they are carrying such an excess amount beyond the 30%. Was that from credit that they took, or commercial credit, or bond proceeds? Do you have any, or have they come forward with any letter explaining and telling us what they're doing about this? Or am I missing something?
No, usually what ends up happening when we see a large balance like that, it's a timing issue related to when agencies are expending their funds for projects. Maybe they're accumulating funds for a very large project that will be spent in subsequent fiscal years. And so when we see these variances, the vast majority of the cases is just that, is they're accumulating funds for a big project that will be spent in a subsequent fiscal year.
We've heard that before, but are these funds that have been delivered to them for expenditure, or are they held by Sandag? Or am I missing something?
You know, all of these, in this case, all of these funds have been delivered to the agencies. So the agencies are holding those funds.
So why isn't Sandag holding back the money until they get down to the 30%? They do, or below?
And that's exactly what Sandag does. So as a result of these procedures for these 4 agencies that exceeded that, Sandag will stop providing allocations until they drop below that threshold.
All right. And I'm not trying to belabor this point, but why is Sandag, how did they get to this amount?
So they, as long as they're in compliance in any given year, and their funds are programmed for specific projects, they have the ability to draw those funds from us based on their anticipated expenditures. We do not govern that throughout the year. It's the audit that provides the information at the very end. We also do not make a July payment to them. So in June, some of the agencies will draw an excess amount to cover July expenditures, and the August payment is a little bit further into the month. So they may draw a little excess to cover an extra month and a half. That's part of it. It's also timing on their side. Perhaps they had expected the project to go forward a little bit more based on their plan for the specific projects. They can draw in advance. It doesn't have to be on a reimbursement basis. And there may have been a last minute delay, which then caused the project to move into the next fiscal year. And so there was this larger carryover on their side.
So Sandag is satisfied with how they're handling this cash?
Yes, yes. They're drawing it based on the requirements of the ordinance. And as Mark mentioned, once we have this no on this attachment where they are not in compliance, we will not pay them further for their congestion relief or maintenance until they provide a certification to us signed by the Director of Finance that they are now in compliance with this amount and will remain so.
Just an observation, I can understand $18,000 and $22,000, but when 1.3 million by Escondido seems like an awful lot. All right, thank you very much.
I actually had a related question. Mark, is the withholding of further funding until the excess amounts are paid down. Is that within the scope of the audit? In other words, to ensure that in fact, as Lisa says, that Sandag has in fact withheld further funding?
It is, we do look at that in relation with other related procedures when we look at Sandag procedures as well, yes.
Well, just to maybe make sure I understand and clarify, take the Escondido thing as an example. If they had hypothetically a $10 million project program and it was in construction and then it was due to rains or whatever, it just hadn't gone as fast as they thought, the money could be here but they haven't spent it yet, so that could be, those type of things would be a reason why this would sit here even though the commitment's there and the project's going.
Okay.
Correct.
Thank you.
Any further questions?
So this is an action item.
Yeah, so if I can go through the next steps and then we'll
Okay.
move on to the recommendation. So the process for the audit is a full year. So we, next week on the 17th, ITOC will present results of this audit to the Transportation Committee. Mark will be there to basically go through the same presentation. And the ordinance has a 60-day wait period from that point before the audits can be issued. So based on counting the number of days, the earliest that the ITOC could issue or approve the final reports would be May 16th. However, that falls after the May ITOC meeting. So we will be presenting the final reports to the ITOC at the June meeting for your approval and issuance. And then in June, at the June 23rd board meeting, the ITOC annual report will be presented to the board, and of course that includes some of the results of this audit process. And with that, we can move to the recommendation. So the ITOC is asked to accept the draft independent auditor's report of compliance audit results, which is attachment 1, including initial findings and recommendations for presentation to the Transportation Committee on March 17th, 2017.
Motion to approve.
Were there, again, I read this pretty carefully. I thought I did. Are there recommendations in there for us or for the agencies? I didn't see any recommendations.
Actually, that brings to mind, and this is more of a, I guess, a governance kind of a question. To your point about Chula Vista's review process of the indirect costs being dated, how does that feedback get to them? And I know this is not a Mark question. I don't know if it's a Lisa question or a Jose question. Could somebody answer
Right,
that?
so if the ITOC was concerned about the dated information and would like that updated or addressed in some way, then we would, Sandag staff would contact the city and have a discussion with them.
I would like to go on to your question. I was wondering if it would be possible, Mark, to give us the indirect cost data soon so we could have, all of us could look at it, before our next meeting. So if we have any questions, we at least could have them addressed.
Yeah, it's no problem at all. I made a note of the request, and we should have it to you before the week's out.
Perfect.
Well, and just sort of following up on my own question, I guess personally I would suggest that staff recommend to Chula Vista that they're a bit of an outlier in terms of the processes here, and that they might want to take a look at updating that.
Why don't we take a look at just in general and maybe come back with a proposal for how up to date an agency's indirect cost rate needs to be. It can't be more than so many years out of date. So why don't we kind of take a look at that? Is that
To create a policy?
yeah, to create something
That's a great
that
idea,
might be,
sure, yeah.
so we can apply it uniformly.
Great.
And then I'll go back to my question, please. I certainly would recommend or accept the initial findings, but what recommendations were in here for us or for the member agencies? I didn't see any, and did I miss something?
There are two action items that that will have to happen. I believe that's on the next agenda item that will be discussed with Lemon Grove and with MTS.
But accepting the report and then considering the recommendations are in fact separate items.
Correct.
Well, unless there were other recommendations that weren't, that did not require further approval, the next item requires approval of the board. But if there were other types of recommendations, such as with Chula Vista, those would be included. And this is kind of standard language that we use. Some years there may be additional recommendations, and some.
So the only recommendation that we're voting on this motion is the recommendation of the MTS, correct?
Well, we'll be covering that in the next one.
That's another one.
Yeah, that's another one.
But there are no other recommendations in here.
That's correct.
Thank you.
I'm going to try my hand at this. I would like to make a motion that we approve the reports that have been given to us verbally that are going to go before the board, with the caveat that the board would like, or I should say the committee would like, additional information on the items that we've discussed.
I would second that motion.
Discussion.
Wait, she has a question.
That would be an alternate motion unless Mr. Tibbetts agrees as the maker of the motion, the original motion, to include that. Do you want?
I can't.
We didn't make the motion.
We already have a motion by Mr.
I don't
Tibbetts.
recall that.
No, I never made the motion.
motion.
I said I would be willing to make the
Okay.
motion. But Carolyn has superseded my offer.
But you can put his name on it if
No.
you'd like.
I make too many motions.
Can I just ask some clarification that includes?
So what I can clarify that we will bring back the actual dollar amount information for the indirect costs.
Indirect
for the
costs.
cities
Right.
that charge that, and the agencies that charge that, and that we will come back with some recommendations about how up-to-date indirect cost rate should be.
That's excellent. Except my other caveat on that one was he had mentioned that he'd be willing to give me, or he had this information as a percentage of the project.
Right.
So I'm really interested in that.
Yes. Good point.
Okay, so do we have clarity on the motion?
Does it sound clear? I'll ask Kim. Kim, you have a very logical mind. Is our
Yes.
motion really muddled, or?
It makes sense.
Tessa, you, okay, you got it, okay.
I will second the muddled motion.
Okay, so all in favor then? Okay. So then if you could move on to 5B.
We'll move on to 5B. So as Mark mentioned, we do have two of our member agencies that did not meet certain requirements of the ordinance. And I'm going to go through the City of Lemon Grove first. So the City of Lemon Grove did not meet their MOE, the maintenance of effort level. They were short approximately $21,000 in using their own local discretionary expenditures. What the ordinance allows is for the city to request up to 3 years to make up that shortfall, of course continuing to meet the MOE during that period. If the board approves that, then it will be checked in each subsequent audit to ensure that over the 3-year period they do meet it. It doesn't have to be 3 years. If they meet it in FY17 in the first year, then it's just done. It will be reported at that time. If the board does not approve, then the shortfall amount, the $21,000, would then be taken from the city's allocation. It would be taken from the FY18 allocation, and it would be then split to the other street and road recipients. It would be the other cities and the county. Also, if the city were unable to make up the full shortfall in the 3-year period, then whatever that shortfall is at the third year would then be split to the other cities and the county.
Can you just point out blue sheet?
Oh, I'm sorry. We do have a blue sheet on this item. It's actually on blue paper. There were some corrections made, and you'll see those in the track change mode. And so now with MTS, they have two, the transit operators have.
Take these one item
Yeah, I was going to say,
sorry.
perhaps could we take them one at a time? 'Cause
Okay, sure.
just-
You
there
have
are questions.
questions?
I've got a question. Let me go. It sounds like
My
you
only
as well.
comment is we've done this before, and I see no objection to it, and would be willing to make the motion
Okay.
for Lemon Grove that we recommend approval, but you're
Well, so I had two questions. One, a general question. Do we track whether, well, we know that in the case of MTS, this is something that they brought last year, and to the extent that the pension costs are driving it, I expect we'll continue to see them on an annual basis on this. But in the case of Lemon Grove, do we happen to know whether they've brought this up in the past or not? The concept of kind of giving somebody a pass and giving them the 3 years to make it up, conceptually, seems fine, unless if you get into a situation where somebody seems to be like a repeat offender, if you will.
Right,
That
right.
might inform the consideration. And I don't know if that gets tracked or not.
I do track it, and I know I looked at it. I just don't think I brought it with me today. We have had this non-compliance item. It's every couple of years it comes up with one of the jurisdictions. I can't recall if Lemon Grove did not meet the MOE in the past. I kind of want to say no, they were not one of them, and I can bring that back to you, let you know for sure.
I'm not sure it's necessarily critical in this instance for the $21,000, but just maybe as we think about this going forward. But the one thing I did have to say is I'm not sure that the letter really shed too much light for me on why this happened.
Right. Yeah.
And so by way of feedback, I don't know that we want to hold it up necessarily, but it strikes me that the letter was not especially informative.
Okay.
I don't know if others share that view or not.
I would compare was.
Right, so we do have Mike James. He is the Lemon Grove Assistant City Manager and Public Works Director here with us, and he can provide you further information.
Great, thanks.
Well, thank you, Chair and members of the committee. So I can shed a little bit more light. I've been with the city for approximately 10 years, the last 6 of which have been Public Works Director, and then most recently as the Assistant City Manager. So when we're talking about the specific amounts that weren't allocated this past year versus other years, and to my knowledge, for at least the past 6 years, we have met our prior MOE requirements. But in this instance, due to dwindling sales tax, property tax revenues, which in the past have been used to be able to be that source of discretionary funds that we've allocated towards our MOE. Unfortunately, those discretionary funds decreased, and we had to rely on other sources, non-discretionary funds, which coincidentally were allocated towards street improvements as well, so gas tax funds. So in this case, that was kind of the gap that we're looking at, that $21,000 amount. Since the time that the audit has been going forward, and Mr. Rojas, who is our interim finance director, and I, in addition to the city manager, who is a new member of the team in the past year, a little over a year now, we've had this on our radar, and we're working through the process to make sure that moving forward, this will not happen again. And really, because it's a combination of the two aspects: one, dwindling revenues, discretionary funds rather, and then changing key leadership roles of the city. So now that this is on my radar as the Assistant City Manager and Public Works Director, it'll stay there, and I'll make sure that these funds are continued to be allocated and meet that MOE threshold moving forward.
That's helpful from my point of view.
I move that we recommend approval of this recommendation, that they have the 3 years to do this and now.
Do you have a second? Second. Any further discussion? Okay, all in favor? I would just comment that the elaboration was very helpful, and that in the future, that kind of clarity of the, a little bit more detail would be helpful just to put into the letters.
Understood.
Call you up here. Thank you. Thanks for coming.
Okay. So we'll move on to MTS.
MTS, yeah.
Okay. So the transit operators have two requirements to meet each year, and one is with bus and one is with rail. And MTS did meet the bus requirement, but they did not meet the rail, and Mark has already provided you some information on that. So the ordinance allows the transit operators a couple of options to correct this. They can request a 3-year average if that is going to work in their favor. They can request exclusion of certain costs that are beyond their control, or they can request a combination of the two. So MTS is requesting the exclusion of certain costs related to the non-cash financial statement reporting, the pension reporting, as Stuart mentioned previously. And so if the board approves this, then MTS would be in compliance with both requirements, and that would be reflected in the final audit report. If the board does not approve this, then the ordinance tells us that MTS for FY17 allocations can only receive the same as the FY16 adjusted for CPI. Now we know CPI was negative, so therefore it's flat, which means that they could receive no more than the FY16 allocation amount. And on page 2 of the report, you can see what that difference would be. It's about $843,000 that they would potentially lose in allocations. Now, and then bringing forward how, has this occurred in the past? Yes. It's not every year that it occurs, but it has in the past with MTS. And with the different financial pronouncements that come out each year, sometimes they do alter the data that's being included in these calculations. And in this case, when you look at the base of the amounts, they are not in the control of MTS. There's an actuarial that prepares the numbers, and then they rely on CalPERS for the other. And if the account isn't I'm sorry, let me find the exact language that MTS used. If the CalPERS pension fund investments were not performing as expected, what they had budgeted, then of course it is something beyond their control, and it does adjust their numbers. And we have with us Larry Marinesi from, he's the CFO of MTS, and he can provide further information on that if you'd like. The attachment 1 is the MTS letter. At the top part of their letter, they are showing both the bus and the rail operations. What they're showing you is that with rail operations, while on a 3-year average, they did not meet the requirement, they're pretty close when you're looking at it as an average. So that's why they're not requesting that. In this case, they're just doing the cost exclusions, which would take them into compliance. And so I wasn't sure if you had any questions for Larry or yes.
Okay, I'm going to act as if Richard is also sitting here, because both Richard and I have been concerned over the years about what is happening. And I somehow, when I heard you talking, I got the feeling like Ray must have had last month, because I think if you base your assumption on your cash flow, but your data is not accurate, then you're going to have a problem, and they've got a problem. And they've, in the past, have had problems also meeting their expenses. What I don't like is, as a taxpayer, I would say, if somebody wants me to exclude costs that are there and pretend like they don't exist, so on paper it looks good, I have a real problem with that. So I guess my question would be to the representative, are we going to keep seeing this? Because who knows what's going to happen? And then do we just every year bury more expenses? That's my question.
I think we'll probably have a few questions.
Yeah.
Thank you, Chairman, and members of the committee. And I just want to echo some of the comments made by Lisa earlier with regard.
Repeat your name and title, please.
Sure, sorry. Larry Marinisi, Chief Financial Officer for MTS. And I just want to again echo some of the comments made by Lisa. And these costs, why I completely understand where you're coming from. You have to understand that these are just truly accounting transactions. It's not cash going out the door. They are really regulations put on us from an accounting perspective to put liability balances on our balance sheet, new GASB pronouncements and actuarial studies that require us now as an accounting department to put the net pension liability on the balance sheet, which has an impact to operations, but you have to realize these are not cash transactions going out the door. We're not incurring additional monetary costs in the current year. It's an accounting transaction that are requirements on our agency from an accounting perspective.
But, okay, I just wanted to follow up and then I would defer to Tracy. But it's like we talk about with the Transnet dollars. Okay, you don't have to pay it today, but at some point you have to pay it. So you've got to have some money there. That's where my discomfort arises.
And I understand that position, and you have to understand that when PERS comes back with their investment return year over year, it's going to fluctuate year over year. There are periods of time where you're going to have returns, as we saw this year, of 1% to 2%, and then there are going to be times where they're going to beat their actuarial rate of return, what they're projecting to make at, let's say, and this has happened in the past, 10, 12%, which will actually reduce our liabilities and actually give us a credit in expenses. So we don't want it, when we look at pure operations, when we have good years from an investment perspective and our liability balances decrease, we don't want to take that as, I guess, a good guy, for the lack of a better word, showing that our expenses have decreased when it's really not a true reflection on how operations work. So there's going to be cycles in terms of our investment returns. And so this year was a poor return from an investment perspective, and so that just increased our liability, which had a negative impact to our operating expenses for the current fiscal year. But over time, they're trying to achieve, I think PERS is now at 7%, their required rate of return or their projected rate of return. So you're going to have cycles where there are some years that are less than 7%, some years that are greater than 7%, but they're trying to hit that target every year. So I guess to answer the question, when there are years where there are 10+% returns, we still don't want to look at those types of transactions, and when our liability balances are reduced, our expenses are also reduced. So we want to eliminate those things to get a real, true, accurate representation of how our operations are.
So the question related to that I have is, in your internal accounting, do you actually separately account for the pension expense of the rail and bus operations, or was it for the purpose of this reporting or this requirement, you said, oh my God, we got hit with this big expense, let's go through this and start allocating it based on rail versus bus?
Now that we have this GASB pronouncement, which just came out, I think, 2 years ago, we actually put that on the books in a separate general ledger account so that we can track that, so we can peel it back, again, to give us complete oversight on really how we're doing from an operating entity, from a cash perspective and also from a true operations forecast.
And again, just for clarity, your reference there to the ability to peel it back, that is on your financials distinguishing between bus and rail.
Correct.
So this just hasn't been like a quick internal exercise to do this. This is part of your actual financial processes.
We look at our financials all the time, whether it's a true operating cost, true non-cash accounting transactions. We always look at rail and bus independently, but also in consolidation to give a really true overall MTS picture.
Great, thank you.
So, as part of GASB 68, I mean, I understand it's divorcing basically the cash activities from the long-term projection of reliability. That's really what it's trying to do. And you're part of putting GASB 68 on your books. You reverse what used to be just your cash payment, your ARC every year. So, as part of this amount that you're recommending to reduce, are you reflecting the actual cash outlay that you make with your ARC as a net of this amount that you're reflecting?
It is, we are within the numbers, they are reflecting the actual cash outlay for our PERS obligation. What we're only peeling back is the impact to the GASB 68 pronouncement that is the, really just that liability balance net change on our books. Does that answer the question?
Well, I'm following up on what Carolyn said. I understand exactly what you're saying, and we probably have no choice. My thoughts are more of an indictment about the pension program and the 7% anticipated or planned for realization. My question simply is, do you have a significant liability that you are carrying for future pension expenses?
Yeah, and again, it's really a PERS plan, so it's really not just an MTS plan.
I understand, but
okay.
for MTS, what is your total liability on your books?
I didn't bring those numbers with me, and I apologize. I don't have a number, but I can forward that to you.
I mean, it really may not be significant in whether or not we approve this or not, because facts are facts.
Sure. Yeah. Well, the one thing I want to, it's an open plan, so this plan is going into perpetuity, and so this liability balance that's outstanding is really going to be, you know, it's going to, there's going to be a long period of time to pay off that debt, for the lack of a better word. So while that number could be a big number, there's an open period of time to really work through that and try to pay off some of that unamortized actuarial liability off.
I've heard it that the longer we go, the more behind we get.
And don't get me wrong. They're looking at this very carefully, and we've done it as well with our own internal San Diego Transit pension plan, where we are looking at the assumed rate of returns. We're looking at actuarial liabilities. We're looking at all these things and coming up with strategies to really lessen the liability that's going to be out there for an extended period of time. So we've done it with our San Diego Transit pension plan. We actually closed that plan for most members. So we're looking at alternative strategies, including, again, closing that defined benefit plan and really coming up with a defined contribution plan. So we've done a number of things to try to limit the liabilities in the future.
I would just suggest that we're somewhat, we're starting to get close to being behind schedule. We've got a fairly full agenda. I would just have one other question, and I apologize that my pension accounting is not what it probably should be. But to the extent that in other years there may be performance exceeds the 7%, presumably there would be a reduction in the liability, and you'd have the opposite occur. I guess from a, I don't know if you want to call this a policy standpoint or just a, practically how we look at these things. In this case, you're asking us to exclude the expense. In other years, it may be that the reduction in the liability results in a gain that actually is the thing that puts you into compliance. So are we in effect saying that from a policy standpoint, we would prefer to exclude this item both as a negative and in other years conceivably as a positive?
Yeah, I think that's fair. If you want to, the whole purpose of this is to really get your comfort level with how we're doing from it as an operation.
Right.
And these are types of costs that will fluctuate year over year. So when we do have rates of return that are above 7%, which artificially reduces our expenses, those shouldn't be included either. So we should look at that, and we can certainly work with Sandag to just at the onset, just eliminate those expenses altogether so that we can show you a true reflection of how we're doing operationally.
So I'm not trying to exceed our bounds in rewriting the policy, but maybe that's something that, Lisa, you could keep on, for the future is, whether it's MTS or another agency, if there's a gain, that is the thing that actually puts them into compliance, that we just take a look at that as well. But unless there are any...
I just wanted to ask, Tracy, I have to defer to your greater brain in matters like this. Do you feel comfortable?
Yeah, I do, as long as they're recognizing the fact that the actual cash payment, the ARC that goes out every year and has gone out every year is included in the expenses that they're doing this calculation. I do. It is a long-term liability. At some point, you would want to see them paying down that liability, but it's going to take 30 years to get there. So I'm okay with that. Thank you.
So then, do we have a motion?
No, thank you.
Do we have a motion?
No.
I move that we accept this recommendation.
Okay, I'll second the motion.
Recommend the recommendation.
Any other discussion? All in favor?
Who seconded? I'm sorry.
I did.
Oh, thank you.
Okay, I think we have an abstention.
I am an abstention.
Okay. Tessa,
Did you get that, Tessa?
That you have an abstention?
Thank you.
Thanks for coming, thank you. And thank you, Mark, as well.
All right.
So Ariana is going to talk us through
Yeah, just real quickly, this report addresses recommendation number 18 from your most recent triennial performance audit. And remember that there was a recommendation that noted that a different method for alternating term limits should be considered to enhance ITAC's effectiveness in overseeing the program. You reviewed options for implementing this recommendation back in October 2015. And then you discussed that changes should be considered leading up to the next solicitation for members, and that's going to be advertised later this month for the terms that are expiring this May. The proposed modifications to the Transnet Extension Ordinance are included in track changes in Attachment 1 to your report, and they include changes that would allow members serving midterm vacancies to serve an additional 2 4-year terms, not to exceed a total of 10 years. Proposed changes also would include further staggering to prevent the turnover of more than 2 members at any one time, and would allow the selection committee to make a determination as to how long each member would serve in instances when more than 2 members are replaced during the same recruitment period. We have ITAC bylaws inserted as well in your attachment, and those include the same changes for the consistency purposes, as well as clarification that board approval is necessary in order to amend bylaws. The Transportation Committee unanimously recommended board approval of these proposed changes at its meeting in February. The board conducted the first reading of the proposed amendments on February 24th as well, and then a second reading is scheduled for March 24th, and a 2/3 vote of a majority of the board present at that time would be required in order to pass this. The ITAC is asked to recommend that the Board of Directors approve the proposed amendments to the Transnet Extension Ordinance related to ITAC term limits. The ITAC also is asked to recommend the Board of Directors approval of the proposed changes to the ITAC bylaws.
Do you have a motion to?
I move that we recommend.
I'll second that one.
Just before we vote, I just have a question for clarification. Is the 10 years intended to be a lifetime, or is it a succession, so that, in other words, some of our valuable members like Carolyn, Kai, Jonathan, Dustin, all of us, might take a couple of years off, but then, or is the 10 years a lifetime?
I think it applies mainly, the purpose is, those midterm vacancies, right? Where we have someone coming in, filling in just a portion of those first 4 years. It's really so that they can, because the way it stands now, they don't get the benefit of filling those or serving for the entire 8 years. So I think that's the purpose. In terms of a lifetime, I don't know that,
Well, what I mean is, in other words, can somebody roll off
Mm-hmm.
and then, 2 4 years later reapply and come back, or is the term limit intended to be or is that just not, it doesn't speak to it, and we should perhaps consider that separately?
I think if you read the language, it's silent on that question.
I think if you serve 4 years and then you take some time off and come back and ask for another 4 years, that's a possibility, right?
It just wasn't clear to me. I think it
yeah,
was,
I mean,
So
yeah.
I think it would allow for the flexibility because it doesn't specifically say it's consecutive terms or.
And I think it also says the selection committee, you know, can look at how they stagger those terms on a case by case with each
I don't want to
recruitment.
box
So
down, but I was just curious about that. So in any case, I think we have a motion that's been seconded, but thanks for the elaboration. All in favor then? Okay. Now, I know you've all been waiting for the presentation on data accuracy.
Is that me?
Because that's what I think about when I get up in the morning.
It's all I've thought about for a long time.
So appreciate you coming down and redoing a very extensive presentation for us.
Sure. So I'm going to do the same presentation that I did for the board. And with that, I had a written statement that I read first before I did the presentation, so I'll be reading that again for you. And if you have any questions at the end, I'd be willing to answer them. So I'm here today to lay out the details of a proposed work plan for your consideration that will get to the root of the errors in our modeling and forecasting process, identify any problems with our work products and fix them, and put into place procedures to make sure that it does not happen again and that the future issues are brought to your attention. Before I get into the proposed work plan, I want to explain to you what happened that led up to the discovery of the errors in our model that in turn affected our revenue forecast for Measure A and our annual Transnet extension revenue capacity estimates. In November of 2015, a few months after I started here at Sandag, I was working on the Transnet Plan of Finance, and as part of that work, I was looking at data that came out of our demographic and economic forecasting model, also known as DEFM. As the new chief economist, I was interested in understanding the data and assumptions because I would be using them to support the agency. It's important to understand that a forecast cannot be right or wrong because the event predicted has not happened yet. A forecast can only be reasonable or unreasonable. And one definition of reasonable is that the future looks like history. If the future looks different, then one must understand the assumptions that make the future different than the past. So as I worked on the plan of finance, I noticed that one of the outputs, taxable retail sales, grew at a faster rate in the future than it had in the past. That's when I reached out to one of my colleagues to confirm that I was looking at the correct data. I had calculated an average historical growth rate for real personal income going back to 1970 of 0.7% per year and future growth rate of 1.31% per year. In and of itself, the 1.31% is not concerning. Many areas have experienced that type of growth. For instance, during the same historical time period, San Francisco's growth rate was 1.6%, Austin, Texas was 2.0%, and even LA had experienced 1.2%. In fact, in the 1990s, San Diego experienced 2.8%. So this number in and of itself is not unprecedented. One would not necessarily conclude that the model is wrong because of these numbers. In the email exchange with my colleague pointed out that the model was forecasting that real average wages in the region would grow from 58,000 to 96,000 by 2050. To this comment, I responded, OMG, and later in the exchange, I wrote WTF. Those comments weren't panicked as reported in the press. The OMG was my way of saying, that's curious, it's a little strange. Given our history here in San Diego, it seemed aggressive to me, and I didn't understand why it was. The WTF was just a follow-on to that. It was not the most professional language, and I apologize for that, just so that you can see what I meant. We've left the entire email exchange at your places today. Did we hand those out? Okay. A few days later, on November 23rd, 2015, I asked my colleague if he could help me understand the assumptions that drove the model. A few weeks after I wrote those emails, our technical staff updated me and several members of the executive team on the progress of updating DEFM. At that meeting, which occurred in December 2015, staff presented a handful of slides out of a working deck which had 51 slides. Really, that PowerPoint deck is a bunch of slides on different topics that are used in case they may be needed during a meeting. The focus of the meeting was on progress made so far on DEFM. The model is used every 4 years when we update the Regional Transportation Plan. Each version of the model is called a series. Series 13 is the one that we are using now, and Series 14 will be the next generation of the DEFM model. The key issues discussed during the meeting were why we needed to simplify DEFM from a simultaneous equation model to an apportionment model. At that meeting, we also discussed the fact that the model was indicating that taxable retail sales produced by DEFM seemed to be growing at a rate faster than expected in the future. The technical modeling team theory was that the long-term forecast was influenced by the underlying data. DEFM is calibrated to Moody's long-term forecast data and to data from the Bureau of Economic Analysis. These data drive our long-term forecast, and it appeared that they were aggressive, therefore our taxable retail sales numbers were also aggressive. It turned out later that this was not the only factor, but we did not know that at the time. We left that meeting with the modeling team assuring us that the anomaly regarding the taxable retail sales would be addressed as part of the DEFM Series 14 rebuild. With that, the team went about their work. Now let's fast forward a full year to just a few months ago. In late October 2016, a few weeks before the election, a reporter looking at Measure A challenged the $18 billion revenue forecast for the proposed new sales tax. As part of the discussion surrounding that inquiry, Gary directed the team to look into the forecast issues immediately. And as you will see shortly, deconstructing the model and finding the problem was a complex and difficult task. It took us several weeks of working 7 days a week before we identified the root cause and were able to conclude that there was an error in the agency's forecasting model that had caused the wage growth and therefore taxable retail sales estimates to be high. The taxable retail sales numbers had in fact been used in the process of calculating the Measure A revenue forecast. As you know, staff explained these concerns and updated you on the Transnet program a few weeks later during a presentation in December 2016. We take the integrity of our data and this organization very seriously. We've always had data integrity and quality control measures in place for all aspects of our work. Nevertheless, there is more that we can do to improve. Since the discovery of these errors, we have generated an independent forecast for the existing Transnet sales tax program while the model is being updated. Gary has consolidated the chief economist position with the director of technical services position to integrate oversight of the forecasting process. I'm now serving in that position. I am here today to go over our proposed plan to systematically and comprehensively review our model and processes to get to the bottom of the problem, to deal with all of the consequences, and put safeguards in place to make sure that it doesn't happen again. This work plan will ensure that these type of issues do not happen again and will define an escalation path so that issues that are identified in the future will be brought to the attention of upper management and to the board of directors. And with that, I will present the proposed data modeling work plan. The proposed plan consists of 7 points, and I'll be going over each one of these in just a minute. So I won't be reading these right now. So the first step of the plan is really to get to the bottom of what happened and be able to report back to the board. So what we're proposing is to do a full evaluation of the Series 13 code base. We're proposing to validate all of the input data, the transformations, and the equations that are in the model to ensure that the data's accuracy is accurate and also to ensure the integrity of the model results. By being able to do this documentation of errors, we're going to be able to confirm that the Series 13 forecast contains no other problems and that we can use the other variables going forward for our forecasting. I want to step back a little bit because this is where the problem was found and explain exactly what happened and what we found. So the last time that the Series 13 code base was updated was in 2012. The code base was written in 1999, and at that time we had moved from using Global Insights as a driver to using Moody's data. But at the highest level, when you take a look at what DEFM is, it's a bunch of inputs. There are 689 historic economic time series pieces of data that we get from 1970 through current year, 2012, that are fed into the model. That data goes through 136 interactive economic equations, as well as demographic and cohort models, and it produces output. And the output that DEFM produces is 471 economic variables and over 1,600 demographic variables, and that is what we consider to be our forecast, and it's for the years 2013 through 2048 in Series 13. So what does DEFM look like? This is what it looks like. It's a spreadsheet. At the end of the day, there are dozens of sheets that look like this with numbers that are output, and there are no formula in here. They're just the output numbers. The issue that we had was over here in column AJ, which is Rtcip is the way that it's abbreviated. So this is taxable retail sales, and it's just a series of numbers. Okay, and these are the numbers that eventually were used in the Measure A revenue forecast. So what an analyst would do is we would go into DEFM, which is this spreadsheet, the outputs. We would copy this column out, and then we would do calculations based upon that. So in this case, it was calculating what would the half-cent sales tax be if these are the taxable retail sales numbers that we would be collecting. This is how taxable retail sales is actually calculated within DEFM. This is the formula. This map didn't exist until we put it together for this presentation. What exists to us is the spreadsheet that I just showed you and documentation that looks like this. So this is the DEFM essentially user's manual, so it's formulas. So we're working between this hard copy and the spreadsheet trying to understand where the problem was. But we put it on a chart so that you could see how these data were actually calculated. So the problem that we were looking at is here in taxable retail sales. And as you can see, here's Rtcip that I showed you from the last one. Well, it's a function of disposable income and overtime and shifts. Well, disposable income is a function of income minus personal taxes. So as you can see, this is a formula that builds upon itself. In December of 2015, what we believed was this variable right here, pay US, which is Moody's US payroll data. It's exogenous to the model, is what was driving taxable retail sales to be high. So we looked through these formula, we determined this is what it was, and this is where we decided, okay, we're gonna do something about that for Series 14. When we were asked to dig into it more deeply, what we did is we started to dig deeper to see what was going on, and we continued to unravel this formula. It goes all the way back to here. And now, I have to admit, we got stuck when we got to labor productivity, because at that point, we run out of formulas that are actually in DEFM, and we now have to go back into the actual databases that are aggregated and that feed DEFM, so all that Moody's data. And what we found is that this data is, there are more transformations that occur before the data comes into labor productivity. And what we found is that the actual error occurred here, which is when we took the source data and created what are called DEFM sectors. So it's taking the Moody's data that we got from the vendor and then transforming them into DEFM sectors. So between these two boxes, there's something called an ETL process. It's an extract, transform, and load process where you take data from one place and you put it into another. There are 391 economic sectors that DEFM, that Moody's gives us. So these are small sectors in the economy. In DEFM, our forecasting model, we only use 50 sectors. So we roll them up into larger sectors. So for construction, for instance, you have construction, there's heavy construction, and then there's home construction. Under home construction, you would have electrical and all sorts of different subfields. So what we end up doing, we don't forecast all 391, only 50. So it was in transferring the information from the 391 to the 50 where there was an error, and we ended up overcounting some of the economic output that came from Moody's. So this is where the error occurred. So we know that there's a problem with the taxable retail sales because it's a function of income. But the second thing that we're going to do, so that the first part of the plan is really to find out what else is impacted by DEFM. You saw that model. There are other variables in there. So we need to kind of trace all of that and figure out what is the extent of the problem. Once we understand the extent of the problem, the next thing that we have to do is to track down each work product that may have been affected by this error and then fix it. So in some cases, it may be very simple because it would just be in the appendix of a report as support data. No difference in the decision would necessarily have been made. However, in some cases, there may have been other calculations that are done on it. So the second part of our work program is to, once we understand what's wrong with the model, track down and fix that, what's wrong with it. What we're proposing to do is to identify all of these impacts and put them into a list. So basically, and this is just for illustration purposes, we would take the product, we would detail out where it's used within the product, we would assess the severity of the error and what the level of effort it is to fix it. And then we'll work with the stakeholders to determine whether or not these things need to be revised or what we actually have to do to move forward with that.
If I could interject.
Move forward with that.
If I could interject.
Move forward with that. Yes.
Presumably you're just talking about Sandag, within Sandag, as opposed to a variety of other entities are relying, different cities, for example, rely on Sandag data. Are you suggesting that you would work at those levels as well, or you're talking about just within Sandag?
So in fact, we will be working with the different agencies, the cities, any of the source point clients that we had or Service Bureau clients that we had that may have used this data. What we'll do is we will track down and find out whether or not these variables were used and to see what type of impact that might have had on the decision that came from the report. So in most of the cases, from what we can tell right now, these are financial variables, and most of what comes out of DEFM that people use are the demographic variables, which are the jobs, the housing, the population counts, and those we do not believe are affected by this. These are really, it has to have to do with these income variables, and it's not the most used variable, but it is used elsewhere. The third thing that we're going to do, once we have addressed those problems, and actually a lot of this work is happening or is going to happen in parallel, is to really understand how information flows throughout our modeling system. And so what we're proposing to do is to map the data flow from the sources of the databases and through the models and through the outputs, and to be able to provide transparency by actually putting this all onto a chart. And it'll also allow us to improve our quality assurance because we will be able to understand when transformations are made and what kind of quality assurance steps we can put in to make sure that we haven't made a mistake in the transformations. The most important thing too is that this will leave a blueprint for those people who follow us, because one of the difficulties that we've had is that this model has been around for a long time, and much of the staff who worked on it doesn't exist. They're not here anymore. So we're going through spreadsheets trying to understand what they're doing. So what we're proposing is to leave something to our future generation of modelers that actually has everything spelled out. This is just a sample of some of the things that we already have. We're putting this all together. We have over 20 terabytes of data that we use in our modeling department. And it comes from 168 different sources. And so each one of those sources come in and they have to be QA'd, and then they're sometimes transformed before they're put into SQL databases that we use for our modeling efforts. And then that data is all fed into our demographic models and our economic models, which impact our land use models, which impact our travel demand models, et cetera. So we're mapping out the entire flow so that we can make sure we have the quality control in place where we need it. Make sure we have.
And when you use the term, I think it was transform, are you referring to that literally a person would take data from a spreadsheet and copy it into another spreadsheet, or or is that at least contemplated in this modeling process review so that you're seeing, you're highlighting every instance where a person actually is manipulating data?
Yes, there will be a step. So when we get data that comes in, I'll just give you a quick example so you understand. We get data, for instance, that's employment data, and we get that from the EDD. The employment data would tell us, for instance, that there are 23,000 people who work for the San Diego Unified School District. And the address that they use is Normal Street, 1400 Normal Street. All 2,300 employees, or 23,000 employees are allocated there, okay? Because they're just giving us the count of people. However, if we want to do travel demand modeling, we need to take those people and actually allocate them to the schools where they work. So they would be the janitors, everybody who works for a school. So we get the data in, and a lot of times it's not in a format that we can use it for our modeling. So what we do is we have people who go in and we remap all of that data to where the people are actually physically located versus where the reporting address is. So there needs to be a QA process that, because we've touched the data and we've now changed it from the source, we need to have a QA process where we can go back and say, did the person who made those changes actually do it correctly, and do we still have the same counts that we had prior that the EDD gave us? So there has to be a step in there anytime we touch the data. And in some cases, we take the data and we may just suck it right in, and then it would be done procedurally using computer program. Big difference between what we're doing now and what we've done in the past is that in the past, much of this was done in spreadsheets, which are prone to errors. We are now using SQL Server as our databases, so the errors are significantly reduced. But with that said, this is a lot of what the agency does. Is data comes in, we clean it, we transform it into something that we need for our purposes, and we put it in another database. But what we need to do is map all that out so that we understand what we're doing with it.
And so this would be the place where you're basically identifying where a human touches and potentially manipulates data.
So what you would see here is this input would represent the EDD data. There would be a quality assurance step. That'll be a hard copy document at some point that says this is what you're supposed to do with it, this is what you're supposed to run. It goes into the SQL database here. There's probably another QA step here that says make sure that the data that comes out of the SQL database matches the data that we put in, so that we can be assured that when stuff comes out of this arrow, that all of this is in alignment.
Correct.
So that. Oops, sorry. The fourth step in the proposal is to get our data organized and professionally managed. And this will include, among other things, hiring a professional database administrator. So right now we have people who understand databases administering their own databases, so we have lots of different instances. What we need is somebody who sits above that to make sure that all of these data are appropriately managed, that we have a layer there so that everyone's pulling the same information. When we pull population numbers, no matter who's using it, that everybody uses the same population number, for instance. So what this will result in is giving us industry standard best-in-class data governance. The fifth step is to have a expert review panel take a look at the models that we're using, specifically the Series 14 demographic and economic forecasting model. And in fact, tomorrow we will have a panel of 12 experts from around the country. 11 of them are PhDs in demographics, economics, and land use, who are going to review the methods, the data sources, and the assumptions that we use for the model to make sure that the model is appropriate for regional planning purposes, and to make sure that we have formulated this correctly.
If I could just ask a question here. It's fabulous that you're going through that exercise at this stage. Is it contemplated, or at least the 7-point plan didn't make clear that you would intend to revisit the model occasionally, perhaps not in as extensive a fashion, but just at least revisit at some point or several points in the future, just to get some perspective that, putting aside the data and the inputs, that the model itself is doing the best possible job at that point in time of doing the predictions that you're looking for.
I think that from a long-term perspective, that's where I would like to go. We would like to start doing forecasting on an annual basis versus every 4 years.
Right.
There's too much that changes in the economy. And so each time, if we're updating the data each year and running it, there's an opportunity for us to look at whether or not the relationships between these formula make sense. And so we would be checking that. I'm also working on implementing a formalized peer review, where if anytime anybody writes a model, that it would be reviewed by peers inside and outside the department and the agency to make sure that what we're doing makes sense.
Yeah, so just speaking to that request by the board that I give feedback, I would make that notion an explicit part of this process, that it not just be a one-time thing, but as you're alluding to, that it get revisited.
It's continuous improvement, and it should be ongoing, and I agree, and we made a note of that.
I presume the costs of all this new work are coming out of Sandag's budget rather than Transnet, or am I wrong on that?
No, it would be coming out of Sandag's budget. What we're doing right now is, and we're well under way of understanding, trying to scope how big this is, how many, and who needs to be working on it, and then what projects are going to be pushed, and which ones are going to maybe have to be taken off the board completely. So right now what we're doing is we're changing the way that we're doing things also in the department, and so some of this is going to be the regular course of work. Like for instance, when I showed you the data mapping, that's going to be part of the way that we do business going forward. It's not there's a one-time cost for getting it up to speed, but from then on, anytime we do any type of modeling or we do get a new data source, we're going to just add that as part of the regular course of business.
And when you say some projects may come off the books, you mean Transnet projects?
No, it wouldn't be a Transnet project. So for instance, one of the things that I was, as an OWP that I was going to be working on is the Regional Economic Prosperity Strategy. And it seems that I need the same people to do this type of work, and also it makes sense to do the Regional Prosperity Strategy after we're sure that our data is giving us the correct numbers. And so that would be pushed out to fiscal 18 or possibly later, depending on how that lays out.
Thank you. A lot of our planning, I said, and research work projects is stuff that we don't feel are sort of mission critical. We would be proposing to the board to kind of either delay or put off, because really the same people that we need to kind of dig into this are the same people that would work on those new projects. So
yes.
Right now we're not proposing any additional staff members. I think we're going to take some staff positions and do some repurposing. We may need some consultant resources, some real specific sort of expert resources, but that's what we're sort of evaluating at the time, and we'll kind of bring forward to our elected officials.
Yeah, thank you.
The sixth step of the plan is to enhance transparency, and what really this means is that we need to make it easier for you, the ITALC members, as well as the board of directors, and make it easier for you to understand the data that we present, because we present so much information, and a lot of it ends up being put into reports in a textual format, which is difficult sometimes to understand or interpret. And so what I would like to do is to start presenting data in more of a graphical or visual way that allows you to see what's happening. And so because there was so much question about the 14 billion and the original Transnet, I just wanted to use that as an example to show you how, if we presented it differently, because all of these numbers have been presented. Every year we come, we tell you what the plan of finance is. If we present it differently, then it might give you a different understanding of what's actually happening. So this is an example of using the in 2002 dollars, the $14 billion forecast that was used for the Transnet extension. So this goes all the way back to 2002. This data comes from Series 10. It does not come from Series 13. So this is an old forecast that was done prior to 2002. But this is the forecast right here. And as you notice, the forecast only went out to 2030. Well, the measure goes out to 2048. So as part of that, we needed to extrapolate the data. We extrapolate the data all the time, especially when we're talking these 40-year, we don't have models that go out that far, so sometimes we have to extrapolate. I think we'd like to make that clear to the board too, because there's nothing here that is modeled. This is just an extrapolation of that line. So this is what it looks like. That's how we got to the $14 billion. Well, if you take a look at the first couple of years through 2006, so the measure was passed during this time period, and we didn't start collecting data revenue until 2008, but I believe it was passed in 2004. You can see that the revenue collection was ahead of what we believed was going to happen. So the model was accurately predicting what was going on. Well, then we hit the Great Recession. Okay, these numbers are all in 2002 dollars. So we've done the math to put it all back into constant dollars. These red bars show the actual collection. The actual collection to date is about $3 billion. Okay? But what you'll see here is that this model now there's a gap over here. This gap is about a $450 million shortfall from what we had predicted. And the reason is that we didn't predict the Great Recession in our model. Nobody really did. Now, during this time period, we had Series 11, Series 12, and then Series 13 occur. And numbers for the plan of finance were reworked based upon, we knew that the economy was coming down and these numbers were coming down. If you take a look at this line over here, if all we do is say what would have happened if we took that line and we moved it down to where our current collection is, okay, because this is what we're now collecting in 2016. So using all the same assumptions that the modelers used back in 2002, the two things that this is corrected for are the Great Recession and the fact that population has grown slower during this time period than we had anticipated. And that's a little bit correlated with the Great Recession. In that case, our collection would have been $10.8 billion. The new forecasts that we presented to the board in December and then also presented here at ITalk, using that model, our new expectation is that we would be collecting about $9.6 billion if you're using a plain forecast. What this shows is the independent forecast. The red, the green, and the yellow line are the three independent forecasts that we're using. The purple line is the consensus forecast that we told you about. This cone kind of shows you the range into which we believe this is most likely to fall. So somewhere between $9 and $11 billion, especially you're talking going out to 2048. We don't know what's going to happen in the economy, but this is where we believe revenue is going to be. But by showing you this type of chart, I think it will give you a better understanding of what's happening in the model rather than just giving you the numbers each time that we come and say, you know, and presenting the new plan of finance and saying we can show it to you graphically like this. The final point in the plan is to formalize the process. So we have really good people at Sandag, we have really good technology at Sandag, and we have lots of processes, but tying those three things together and making sure that everything is in alignment, the people, processes, and technology are in alignment, is extremely important. And this is where these processes for data, for instance, for the QA of the data would exist. So I know that the agency depends on my team to manage the data assets, maintain complex models, and produce dependable forecasts. And the team is dedicated to restoring the integrity of our data, our analytics, and our modeling that are used throughout the agency and our work programs. And if you look at best-in-class private companies, they work hard at aligning the people, process, and technologies. And this 7-point plan that we put forth for consideration to the board and to you now, the ITalk, will help bring those practices to Sandag's Technical Services Department, as well as to get to the bottom of the problems that happened with DEFM, to fix any of the work products that need to be fixed, and to make sure that this doesn't happen again. So with that, that concludes my presentation, and I'm happy to answer any other questions that may come up.
A couple. First of all, Ray, that was excellent. I really appreciate that.
Thank you.
I heard you say that you don't believe this will affect population forecasts. Is that correct?
That's what I believe.
That's what you believe. All right. My other question is a simple one. We're going through a big minimum wage bump. And that, I believe, is pushing salaries and wages on up accordingly, which, unless it's all wiped out by housing and groceries and so forth costs, it should increase sales taxes, I would think. Am I correct or wrong?
Well, it would increase sales taxes if nothing else changes, meaning that you have the same amount of people spending, same amount of population working, same number of jobs. The issue really is if you raise the sales tax, or if you raise the minimum wage, what is the trade-off between the number of employees that would be hired and the number of people working? Because in many cases, what you may end up having is fewer people working or then part-time people working. So I think that's going to have to play itself out.
All right.
The whole jobs thing is very complex, especially given some of these the H-1B visa issues that are facing the high-tech companies right now, whether or not you can bring people in at the top end, also if you can bring people in at the bottom end. A lot of the Trump policies could significantly impact that. And in fact, if we end up with a smaller labor force, we may end up seeing $15 minimum wage just as part of a natural competition to get labor to do the work. We're near full employment right now.
But that could decrease the population, could it not? If you can't get a job, people won't move.
That's true. The majority of our population increase is due to natural increase.
Yes,
Although,
yes.
I don't know that people would be necessarily moving here for the minimum wage jobs. So I don't know how much shift that there really will be.
This is an interesting subject. I don't want to nominate. Who else wants to ask questions?
You know something?
Well, I'm curious what you said the board asked us to have input. I guess I think it's great. It's a good explanation, but it's the other side of. To me, it's the other side of. It's not the side that's under our purview primarily. I mean, our from my perspective, our purview has always been overseeing the accountability of the expenditure side, which is, the actual performance and the financial compliance, like we do with the audits and things. And so this is like we're getting into oversight of where the money's coming, or how much money there's going to be, and we don't really, it's. It's like Ray said, it's a forecast, and there's all and they're trying to fine tune and be better at the forecast side. But I guess I'm just curious what others think, because first, where was the board asking us to get involved in, and second, how do you guys feel about how this falls under our purview? Because, from my perspective, the ordinance and the guidance for ITALC is to enhance accountability of the expenditure, oversight of the expenditure.
If what I heard Stuart say, I heard accurately, I think the board doesn't have a lot of taxpayers they can just go to for advice. We are a committee of them, and we're taxpayers. Maybe what they're looking for is, how did Ray's proposal, resonate with us? I mean, do we think this is logical? Do we think this is something that's acceptable? If you ask me personally, I think it was really a great presentation, and I like your use of graphs. I think it's terrific. And I also like when you have the missing chunk in there and you tell me what that chunk represents, because I've seen graphs before. They go like this, but you don't know what does it mean, what's missing there, how many millions or billions is missing. So I loved it. I thought it was great.
Thank you.
I don't know if Kim, Jose, or Ariana, if you have your own perspective on the board's.
And I wanted to kind of close, because the board's action last Friday? Last Friday was a couple things. So they received the same pretty much exact same report. They did end up approving the 7-point plan, but asked that we also bring it to ITALC and for your input. And then they approved moving forward with an independent examination about kind of who knew what when, right? Because the staff has sort of put forth the information. There's still sort of allegations in the media about that some of this was known and hidden and or not shared. So that process is actually moving forward. Chairman Roberts had asked that board members send him recommendations for an independent party or parties to consider, to lead up this independent forecast. So at our board's meeting of their executive committee is this Friday, and that item is on the agenda, so to proceed. And there has been a handful of board members that have made suggestions about what to do with that. So that's sort of going to proceed on this. I think they're really looking to see, is this a relevant, is the work plan going forward? Does that make sense? To kind of address sort of your issue on kind of expenditures, I think the revenue side is within your purview. Well, obviously it's not required that we collect a certain amount. So even with the original 14 billion, there was I don't believe anybody's expectation that we were guaranteeing we're collecting 14 billion. So but I think, hey, our forecasting methods reasonable? You do see the marriage of sort of revenues and costs, expenditures in the plan of finance. So the board does make certain decisions based on where we expect at the time revenues to be and where expenditures are on how projects get advanced. So I do think there is some of that, at least from a staff perspective, that it is covered and would fall within your purview.
Kai, we've been beating on the city of San Diego because we question their planning processes and their delivery system, and so that the money is spent wisely, but also so that it gets spent. So I think we're doing more than just checking on the legality or the properness, the compliance of the expenditures. We felt that San Diego was bottlenecked for some reason, for reasons that have been discussed, and I think they're working very hard now to resolve this issue. I think this is our business to at least be aware of it. I certainly haven't got any suggestions to change it. You put so much time into it. As Carolyn said, seeing the chunk that we lost following the recession was fascinating. I presume that Sandag is using this for planning what projects can be built in between now and 2048, because we're going to be about $2 to $3 billion less than what we originally thought. So I think that this is our purview, although I certainly have no suggestions for change to what Ray is proposing to do. Does that make sense?
I guess I would just answer the question of the purview is an interesting one. I mean, I've read the ordinance several times recently, particularly in light of having some interviews with the media just to be able to speak to that. But putting that aside for the second, I think the spirit, my sense of the spirit of the board was very much what Caroline was saying, is that we're an existing body of independent individuals who have some involvement, and I think it was really more that they were just looking for the feedback as opposed to, thinking about what does the ordinance say about our actual purview.
Yeah, I think, well, I mean, I like everything that's been presented, and I appreciate the information. I was more thinking along the lines of, whether it's this plan or another plan or, 100 different plans that somebody could have, we can't influence how people spend. The money's gonna be what the money's gonna be, and so we're, and it's important to have some forecast so that you don't, you have an idea where you're in your, I know there's the near term and then the long term, so we're looking at both ways every year, and so I think that's important. I guess I addressed it last time a little bit, is that, I think ultimately, we get a lot of talk about, where that delta is of, 12 billion or 14 billion or 16 billion or whatever, some number might be, and there's so many factors that beyond, this is just a small component of the total pie of money needed to complete the program. So I just get a little getting too wrapped up in one. I mean, it's important. I'm not dismissing the importance of it, but you know, are we getting too much focus? And maybe it's more on the media, but you know, too much focus on one component of a much bigger picture of the needs that complete the program.
But it's not just one component. When you think about it, the reason that many people say that this latest measure did not pass during the election, this tax measure, is because people have lost faith in what was really going on with the money. Were the projections that we made for last time true? Do people here at Sandag know what they're doing? I mean, you can win or lose an election based on perception. So if you've got something that's strong and you can explain it and you can show where each component of your data is coming from and why you think the way you do, you're much stronger. So I think it's pretty important from my perspective.
One other thing I would throw out, and this probably isn't so much as a modeling question or issue within your purview, maybe a very different kind of context, but vis-a-vis the concept of feedback to the board, I would suggest that perhaps there also be some review of the, for lack of a better word, the sort of the whistleblower type processes, because, you know, without knowing what happened or really wanting to get into the discussion, it just makes me wonder if the voice of San Diego had some of this stuff sort of delivered to them, because I kind of question whether they just independently would have been able to
get the
emails. Get into this level of detail, or frankly, having spoken several times to the reporter, that there was the capacity for them to understand the information, even if they had uncovered it. And so that, in my mind, just raises the question of whether, you know, theoretically, conceivably, somebody within the organization was frustrated by the fact that there was an issue that perhaps wasn't getting dealt with as quickly or as fast as possible. And so that, to me, that speaks to the question of whether there might also be some review of, for lack of a better description, as they said, the whistleblower type processes, so that if there is somebody anywhere in the organization who feels as if they've raised their hand to say, hey guys, somebody needs to look at this, and it's not, you know, quite happening in a way that they think is appropriate, that it, you know, that there are ways to get it to the attention of the senior staff and perhaps even the board, if appropriate. And I presume you have a whistleblower policy.
I'm sure we have.
There's probably an 800 number for anonymous tips and all that stuff that a lot of people do. But
I believe we have a suggestion box. I know when we do the annual audits with the external auditors, there is a message that goes out that says, and under, you can please correct me if I'm wrong, but if there's any instances of fraud or, you know, to contact the auditor, and that information goes directly to the auditor, that there's no intervening way. So there's, I think we do have a number of ways, but we can definitely, you know, take a look at that.
And I'm not suggesting that that's actually what happened, but it just raises at least the theoretical question in my mind if that's something that you might want to consider as part of this. Anything else, anybody?
Thank you.
Well, thanks, Ray. The next item, I think, is jointly Jose and Ray. Talk about the plan of events.
Well, it says on the agenda possible action. Or we.
I'm not sure that there's a need to vote to approve this, but rather that to the extent we had any feedback. And I presume Ariana's taking good notes to what their feedback is.
Yeah, a couple things I kind of tried to we can check was that, Stuart, your comment about just making sure, I mean, we're going to do this peer review right now, but to make sure that that kind of peer review process is built in for the modeling program in general, on a continuous basis.
Right.
And then this issue of the whistleblower process, and then maybe just feedback to the board that you guys did like kind of these graphical, and then I think hopefully the next report we're trying to show you that as well.
Yes. Thanks.
Okay.
So at your last meeting, we were talking about the upcoming plan of finance update. And one of the things that you requested that a separate report be brought back to the ITOC, just outlining what the assumptions are that we will be inputting into the plan of finance update moving forward. So these assumptions in the past have usually been incorporated into the plan of finance report itself. This time we are bringing to you just a report that just covers the assumptions before we bring you the results of the plan of finance next month. So quickly, just wanted to go over what is the purpose of the plan of finance. In this instance, what we're looking at mainly is the major corridors section of the ordinance. So the ordinance covers several different pots of money. There's the major corridors, which includes the highways and the managed lanes and the major transit projects, the capital projects that we work on. There are other elements within Transnet. There's operations, there's the money that goes to the locals and the bicycle, pedestrian, and so forth. The main purpose of the plan of finance is to cover the major corridors component of the ordinance. The ordinance covers, or excuse me, the plan of finance really it's a tool. It's a strategic tool that allows us to look at the financial capacity in two different time frames. There's the short-term time frame, which covers essentially the next 5 to 7 years. And in the past, what we've typically called this is the early action program. So the next 5 to 7 years, the projects that we're working on over the next 5 to 7 years is one of the main focuses of the short-term review. And then there's the long-term analysis, and that covers the remaining years. So beyond that 7-year period, all the way through 2048, those are the projects that we haven't yet started working on. Those are essentially covered in that longer term period, and then the longer term revenues are also incorporated into that. When we update the plan of finance, we update the costs as included in the latest approved Sandag budget. We also include the latest assumptions for schedules. The schedules have a big impact, not just in terms of when we know what something is going to happen, but that also determines the timing of the expenditures, and that's very critical in terms of reviewing the financial capacity over the short term. And then we also review revenues. So revenues includes the Transnet revenues that Ray just covered, but it also includes all of the supporting revenues, state funds, federal funds, and even within those, there are formula funds that come to the region. There's one-time funds that come to the region. So all of those are reviewed and updated with the latest information that we have as we move into the plan of finance. One of the things that I did want to mention here, and it's on the last bullet, is that especially in terms of the plan of finance, the Transnet revenues, the forecast that Ray produces is essentially a forecast of growth rates over time. So, 2% or 3%, whatever that case may be. And what we do every year is that we ground it. We apply those growth rates on the latest collection that we've received. So what we do is, instead of looking at what was forecast, let's say back in 2002, when we had that, the 14 billion number, we look at what was the actual sales tax that was collected in the last completed fiscal year. So in this case, we look at the amount that was collected back in June of 2016. That is the last the last year of collection, and from that point forward, we apply the growth rates. So that's one way of bringing the forecast back into actual collections. There we go. So moving forward, one of the changes that we are doing is that in the past, when we applied when we updated the cost estimates, we looked at the cost estimates that were included in the ordinance, and we updated those costs based on escalation factors to account for inflation to the year that we were doing the plan of finance update. Moving forward, and as a result of Measure A, we're now incorporating the cost estimates as included in the regional transportation plan, and I'll go over the sort of the relationship between the RTP and the plan of finance and a couple other documents that we have, just so that it all makes sense. In the past, we also provided more of a point estimate in terms of where we thought we were going to be, and as Ray alluded, one of the things that we want to provide is, as part of the greater transparency, it's also a greater understanding that all of these inputs that we're putting into the plan of finance, they are assumptions, and assumptions tend to have a certain degree of uncertainty associated with them. Some assumptions are more certain, some assumptions have a greater degree of uncertainty. So we want to provide a range in terms of where we think, the reasonable range of where we may be, both in terms of costs and in revenues. So that's something else that we're moving forward that we're going to be including. Just one point that I wanted to make is that the plan of finance is calculated and shown in year of expenditure dollars, and so what that means is that there's no adjustment made for inflation. Everything is shown as it would be collected in that year. So we show the money for this year in this year's dollars, but then whatever we assume, let's say for the year 2025, we show it in 2025 dollars. We don't bring it back down to account for inflation. Okay, so I wanted to just quickly go over the relationship between four major documents or programs that we have, and the interrelationship between all of them. So starting at the top, the Regional Transportation Plan. This is the agency's long-term transportation blueprint. It is updated every 4 years, and it includes all of the surface transportation projects that the region, whether it's Sandag or Caltrans, the transit agencies, the local agencies, everybody that works on surface transportation, all of those projects are included in the RTP. It currently goes all the way to 2050. It includes the cost estimates for the capital projects. The transmit projects are a subset of that RTP. There are other projects included in the RTP. Something else that it includes are revenue forecasts, not just Transnet, but state and federal. Everything that supports all of the projects, whether it's Sandag preparing or completing those projects or local agencies. Those are included there. And one of the things about the revenue forecast is that federal law requires that the assumptions that are included in the RTP be reasonable in nature. And what that means is that you can't just assume a particular fund source and just say, oh, it's going to grow at 100% every year. Well, that's not reasonable. So you have to look at each one of these revenue sources. Oftentimes we look at history. I think Ray mentioned that one of the sort of definitions of reasonableness is, well, take a look at history and how that particular fund source has behaved. So same thing with the RTP. Looking forward, we need to make sure that all of the revenue forecasts, whether it's Transnet or some other revenue, are reasonable in nature. The Rtcip, you're all familiar with the Rtcip because we bring amendments to you, and every 2 years we bring a brand new Rtcip. So the Rtcip is the implementation, essentially the first 5 years of the RTP. And the Rtcip includes all of the revenues that are committed to specific projects for that 5-year period. So it includes funds that other agencies have told us we can expect to receive over the next 5-year period. That could include Caltrans, the California Transportation Commission, federal government, and that would include our 5-year forecast of revenues for Transnet. Then there's the program budget. So this is the Sandag program budget. The Sandag program budget includes all of the capital projects that the agency is working on, the Transnet projects that we're working on, And it includes both the expenditures, the anticipated expenditures, as well as the anticipated revenues that support those expenditures. There is a feedback between the program budget and the Rtcip. What's included in the program budget needs to be supported by the programming and the Rtcip. And both of those, all of those projects need to be included in the RTP. Otherwise, you can't include them in the Rtcip. So then lastly, the plan of finance. So the plan of finance, as I mentioned, has a short-term period, which is about 5 to 7 years into the future. And then there's the longer term, which is for all of the remaining projects. So essentially what you see in terms of the 5 to 7 year outlook, all of those projects are the capital projects that we're working on and that need to be included in the program budget and that also need to be included in the Rtcip and the RTP. As we update the plan of finance every year, as I said, this is a strategic tool that allows us to look at the anticipated revenues and costs and any potential opportunities to, let's say, can begin the next phase of work for a project that we have, perhaps begin a brand new project off of the remaining list of projects. And so as the plan of finance is completed, let's say that it's a good year and we received an infusion of funds from, let's say, the state government. We would run the plan of finance and identify capacity to do more work in the near term. So that in turn, we would go to the board and say, board, these are some of the potential options you may want to consider to make use of this opportunity. And so they may say, yes, we would like to use these funds to complete this particular project. So we would potentially take a project from the remaining set of projects that we still need to work on and essentially add it over here to the short-term list of projects. That would need to be incorporated through a budget amendment, right? Because the plan of finance is not a budget document. We need to go to the board and ask for the board to update or amend the program budget. And we would also need to amend the Rtcip. We would come to you to amend the Rtcip. Because all of the projects in the Transnet program are already part of the RTP, there's no amendment to the RTP that's necessary. So as you can see, there's sort of a feedback that goes between the various documents because they are updated at different points in time. They either inform, let's say that like the RTP is updated every 4 years, so it will take all of the latest information that we have that's been developed through the plan of finance, it would include that as part of its, essentially the base case scenario that the RTP has. So just wanted to cover this sort of the bigger picture, how the plan of finance relates to our budget, the Rtip, and then sort of the larger RTP. All right, so moving forward. What I wanted to do was provide a side-by-side comparison of the assumptions. And again, these are just the inputs that we will be using as part of the update. We will be coming back next month with what the plan of finance is telling us in terms of the health of the program. So starting off, wanted to talk about sales tax. So this is the short term, and what we included, so just maybe a little bit of kind of a roadmap. So what we have normally here is the 2015 board approved plan of finance. This is the one that was approved back in January of 2016. And then over here on the right hand side is the proposed assumption for the upcoming plan of finance. In some cases, you'll note that the years are a little bit different. And I will cover the reasons as to why they are different. And essentially it's because this is a rolling exercise where we constantly are going 1 year into the future as we update it. So the short-term forecast for the sales tax with the last plan of finance cover the years 2016 to 2020. Now we're 1 year into the future, so now we're looking at 17 to 21. It's moved 1 year into the future. Last time we had 574 million as the assumption of sales tax dollars. And keep in mind, this is just the amount of money that's coming to the major corridors component. It's not the entire Transnet. And then for the proposed, we are providing a range. So 530 million to 585 million. The range is consistent with what we brought to the board in February. We also provided to the board a range, a high and low range. So in this case, it's about 5% off of the estimate number that we have.
If I could ask,
Sure.
just mathematically,
Yes.
if the high number of the range for the update is lower than the rate of growth, even lower than the low end of the range in the rate of growth for the prior, how is it possible that you have a number, the 585, greater than the 574?
My question is that.
Okay, so
Is that because of what happened in 2016?
a couple of things.
Sort of unusual?
So, right, so the forecast that we did back in, the revenue forecast that we included as part of the 2015 Plan of Finance, that was based on the old DEFM-based forecast that we had. As you know, back in 2016, we came to the board and said, we're going to use a consensus-based forecast that in essence is lower. So that's one change that's occurring. It's a different forecast that we're using. Secondly, back then we were using just a single point number.
Right.
Here, if you took the mean of those two, would be about 550 or something. And then off of that number, there's a high and low, plus or minus 5%. Does that answer your question?
I understand the point that the median, or that the midpoint of the after, if you want to call it, the proposed range would be lower than the 574. It still seems like because you basically had a growth rate that was, there wasn't really a range in the growth rate in the 2016 number. It still seems a little counterintuitive, but I don't want to belabor it.
Okay,
Just trying to,
all right.
I think though that just
also, it's, the 5 years are different, right? So last year you had 16,
16 through 20, and now it's
Yeah, I was going to say, so just
dropping off 16, which is going to be lower, and then you're adding 21,
21, which are
Okay,
higher.
yeah, I got you. So just from a consumer standpoint, by way of feedback, I think the question I asked speaks to the issue that anytime, if you're going to make it less than an apples to apples comparison, it starts opening the door to some confusion as to what's driving the change. Is it the difference in the time period, or is it the difference in the key variable? But I understand the reason why you need to do it this way. So.
I have just one question. Did you base these percentages on what Ray just presented?
Yes.
Okay.
Okay, so this is the short term. So this is the next 5 years. So long term, so this is looking beyond that time period. So for the 2015, it's from FY21 to 48, and the proposed one is starting in fiscal year 22. Here's where you see actually a greater change, and this is, again, as a result of the revised forecast that we're now using. So a year ago, we were using a higher forecast, 7 billion, and now with the forecast that Ray talked about, which is lower, more conservative as we develop and identify whatever issues there may have been and so forth. So we're using a more conservative forecast, and also including a range to this particular forecast. So moving forward, starting in fiscal year 22, we anticipate anywhere from 5.5 to 6 billion coming in to support the major corridors program.
And it's also lower because of one less year.
And it's also lower because one less year. Okay. Okay. Any questions?
Good.
Okay. All right. So we wanted to show this graphically. So this is adding up both the short term and the long term. So this is the whole, and again, the blue bar would be one less year, because we're looking forward. We've essentially completed last year, and we are showing the potential range plus or minus 5%, that would be anticipated to support the Major Corridors program. So just from a transparency and from an understanding, I mean, let us know if showing it this way is something that's easy to understand, or if you would prefer to see it some other way. I mean, obviously we're open to any feedback, any input that you might have. Okay, now moving on to state and federal matching revenues. So these are the programmed and reasonably committed funds. So we have, if you look at the plan of finance, we have state and federal funds in the near term, essentially those that are already programmed in the Rtcip, things like the RSTP and the CMAQ funds that are already included in the Rtcip, the full funding grant agreement that we have from Federal Transit Administration for the Midcoast project. All of these funds have already been programmed and or are reasonably committed, meaning Federal Highway Administration has said you can program these funds for your projects. So those are near-term funds. These are the funds that would be included, say, in the agency budget, and these are the funds that would be included on projects in the very near term. So they total about $1.85 billion. As you can see, it's a very, very small difference. And so this, we wouldn't expect this to change hardly at all. So for this one, we're not applying any range, potential range, because we're pretty certain that these dollars have a very small likelihood of changing. Not saying they wouldn't, but there's a, in terms of the degree of certainty, these are some of the more certain funds. And then, looking more into the future, there's the state and federal matching formula revenues, and these are the anticipated revenues. These tend to be things like, and we've listed them here, the federal CMAQ, federal RSTP, and the state STIP. These are also based to a very large extent on the same assumptions that we have in the RTP, which have already gone through a reasonableness review. So these are the assumptions that we have going all the way to 2048. As you can see on the chart, or on the bars, last year we had it at 6.7 billion, sort of a very single point number. Moving forward, there is some uncertainty. There's changes at the state level, there's changes at the federal level. So we want to provide a range that's plus or minus 10%. So in this case, starting in fiscal year 2020, we would anticipate having anywhere from 5.9 to about 7.3 billion to support the program. Another assumption that I wanted to cover here is what's shown here, the percent share dedicated to the Transnet Major Corridors. So since the program started, we've looked at how much money from formula, meaning the funds that I'm showing here, are anticipated to come. And these are very reliable in terms of what we anticipate getting. There's a certain percentage that's dedicated to support the Transnet program. So in this case, 90% of the funds that are anticipated to come are dedicated to support the Transnet Major Corridors program.
From the giver?
From the giver?
No, in other words, did the Fed say to you, or
no,
that you?
No.
You?
This
okay,
is a board policy decision,
okay,
and essentially what we've asked the board to approve is, board, in order to complete the Transnet Major Corridors program, you've got Transnet funds, but you also have these federal and state formula funds. We need to set aside or dedicate 90% of those to support the Major Corridors program. The other 10% are used for other regional programs, such as the van pool program, the freeway service patrol, things like that. That level has actually varied over time. it has varied from 86% to 94%. So in times when costs were going up, we needed to have more revenues dedicated, and so that was brought up to 94%. Right now, it's been at 90% for several years, and we continue to propose to keep it at the 90% level.
Quick, would you go back to the previous slide for a quick question?
Oh.
Should you put dates in that up in the upper area?
Yes, we should. Thank you.
Okay, that's my only comment. Thank you.
Yeah, we can fix that. Thank you. Any questions on this slide here?
Yeah, I know you're going to talk more about this next time, but just I couldn't help myself. With regard to the matching formula type funding, you know, this Dick's question, this is very explicitly based on matching revenues that are eligible to be spent on projects and not revenues that would have to be dedicated to debt service repayment. Right?
Yes. And also something else to mention here is that these funds currently, when we say matching, there's two ways of looking at the matching. One is when, let's say, the federal government requires that you have matching funds, otherwise they will not allow you to use their funds. So that's one way of looking at the matching funds. The way that we're currently using the CMAQ, RSDP, and the STIP is that these are essentially contributing funds to fully funding the various projects. If you look at any one of our projects in the budget, you will notice that the vast majority of them don't have a single source of funds paying for them. So the Transnet, the CMAQ, the RSDP, the STIP, and perhaps other funds, maybe one-time funds or grants or whatever, all of them form a financial package, and they are not necessarily matching each other, but they're contributing, all of them, towards fully funding the package. These funds come to the region regardless of whether the region has sales tax. So these are not necessarily needed to attract these funds. These are formula funds that come to us. Okay, so I just wanted to make that distinction. There are other funds where you do need to have your own local fund source in order to be successful in attracting those. Okay, this is another assumption. The SR 125 toll revenues, you may recall that a few years ago, Sandag acquired the 125 toll road. There was a loan from Transnet that the board approved in order to acquire that. And so last year, we still had an assumption that included annual repayment back to the Transnet program from the 125 toll road. And the payments totaled $89.3 million. At this time, we are on the final stages of refinancing that loan, or excuse me, refinancing a TIFIA loan that will allow us to pay back the Transnet program. And so essentially, we would have the dollars coming in much sooner, and this is where the time value of money gets a little bit complex. The $89.3 million is about $2.5 to $3 million worth of payments every year for many years until the payment is made. The $66 million that's shown here, that's $66 million that would be received this year. And so it's actually, for us, it's much more valuable to have that money today because it's in today's money and not in 2035 or whatever the case may be. So this is just one change that we are proposing to make. Okay, next one is bonds, bond anticipation notes, grant anticipation notes, and commercial papers. So the plan of finance includes assumptions for different kinds of financings. And so those proceeds are then included into the plan of finance. So just quickly, the bonds, those are the sales tax bonds that Sandag issues about every 2 years. So the proceeds of those are included into the plan of finance. The bond anticipation notes, those are short-term notes, let's say 2 to 3, maybe 4 years, that we are currently evaluating to support the Midcoast project. So just very quickly, we are pursuing a TIFIA loan, and I'll talk a little bit about the TIFIA loan in just a second. And one of the things about the TIFIA loan is that you can lock the rate, right? And so, but you don't have to draw on the loan right away. So what you can do is hold off on drawing down on the loan for a few years, and in the meantime, you can issue bond anticipation notes, which, because they are short-term, they have a lower interest rate. And so we can save on interest charges, already having the certainty of having the rate on the TIFIA loan locked in. So proceeds from the bond anticipation notes are also included. Grant anticipation notes are also associated with the Midcoast project. The full funding grant agreement is about $1 billion, but it's not $1 billion all at once. We will be receiving the full funding grant agreement over about 10 years, but we need the money over the next 4 years because that's how long it's going to take for the Midcoast project to be completed. So we essentially need to advance those federal funds through the issuance of grant anticipation notes. So what that means is we issue these notes, and as we receive the full funding grant agreement dollars, we pay back the grant anticipation notes. And then lastly, commercial paper. This is a tool that we have here at Sandag, approved by the board. Essentially, it's like a line of credit, if you will. It's very short-term debt, and it's very low cost. We do have some assumptions for commercial paper in the program, and so when you add up all of the bonds, the bond anticipation notes, the grant anticipation notes, commercial paper, the range is about $1.25 to $1.38 billion. It has gone down from the last plan of finance that we did a year ago, and the main reason is that our latest estimates is that we will be able to cover expenses relying less on the proceeds from financings in the near term, which means that we won't need to have as much of these proceeds. So I mentioned the TIFIA loan. So this is a loan that we are pursuing with the federal government. The TIFIA program stands for Transportation Infrastructure Finance and Innovation Act. Essentially, it's a credit assistance program. It is a loan, not a grant. And we are pursuing this particular loan for the Midcoast project. A year ago, we thought we were going to need $585 million. Since then, we've refined the financial plan for the Midcoast project, and that number has been revised slightly down to $571 million. Just as an update, we are currently in the final stages of negotiating the loan documents, and we hope to bring the loan documents to the board for approval in April. So we're very close to closing on that. Okay, I wanted to talk a little bit about future voter-approved statewide initiatives or federally approved infrastructure plans. So this is one assumption that's also included in the RTP, and it has gone through the reasonableness review that the federal agencies provide. Essentially what this is over the last 2-3 decades, there are several instances where voters or state government or the federal government have approved one-time injections of funds. And so, you know, I'll show you the range right now. It's about, what we're assuming is about 3.1 to 3.8 billion. But let me show you the, there. All of the instances over the past 2 to 3 decades that either voters or the legislatures or Congress have approved these one-time infusions of funds. What that tells us is that there is appetite from either voters or from these legislative bodies to recognize the need for additional funds and to approve those initiatives. These are fairly substantial in terms of size, how much money was dedicated. They have varied. Some of them were very project specific, like the traffic congestion relief program. Others were specific to certain programs, but not to certain projects necessarily, like Proposition 1B. There's cap and trade, which supports certain kinds of projects. So over time, there's been all of these one-time infusions of funds. So what we are assuming is that this interest and this desire to continue to fund projects will continue into the future. And so the assumption that is included both in the RTP and also in the plan of finance is that that will continue. And it's essentially the way that we size that assumption is we say, okay, it's probably reasonable to assume that there's going to be something similar to Proposition 1B approved about once every 10 years. So it could be a combination of some of these. Obviously, whatever comes next is going to have a different name. But the assumption is that there would be something similar to Proposition 1B about once every 10 years. And so we take what the region received from Proposition 1B, and we divide it by 10, and essentially that's what gets included into the plan of finance. Now, one thing that I do want to point out is that the assumption for those funds begins until after that short-term period. So in this case, the plan of finance would begin, or those revenues would begin until fiscal year 2024. We do that for a couple of reasons. The Rtcip requires that we have committed funds. Well, since this particular initiative hasn't been approved yet, we can't assume it in the near term so that we can program it. The other one is we want to maintain the possibility that these will continue to be approved as they have been in the past. But we don't necessarily want to show it in the near term where additional capacity would be identified that's not really supported yet by those dollars. So any questions on this particular assumption? Okay, so these are one-time infusions of funds as they have occurred over the past 25 years or so. And then lastly, potential new funds. There's been a number of initiatives and studies and so forth to begin to address changes in technology. So for example, some of the proposals that you've seen through the legislature, which haven't yet been approved, but they continue to be proposed, are changes to the vehicle license fees. And those are in part to address the fact that electric vehicles are not purchasing fuel, and so they're not contributing to the various transportation accounts. And so, but they're still using the transportation network. So how are they contributing toward their fair share of maintaining and expanding the transportation network? So there's been proposals to increase the vehicle license fee, which would then include additional funds coming in from these electric vehicles. Road usage charges, same thing. It's just taking a look at how can we better address vehicle miles traveled and try to restore some of the funds that have been lost or are anticipated to be lost through the implementation of newer technology vehicles. The assumption that we have here under this particular area is that if you look at the STIP is a program, the state program that back in 2000 used to provide about $100 million per year to the region. Since then, it only provides about $30 million to the region every year. And so the assumption here is based on what would happen if the state government or even the federal government were to be interested in just restoring the purchasing power that we had back in 2000 for the STIP, which was a stable, long-term source to address some of the changes, technological changes that are coming. So that's how that range was developed, just trying to restore the purchasing power of the STIP. Again, this one is not included in the near term. The first year that particular assumption would be included would be in 2025. Included would be in 2025. Included would be in.
Do we receive the gas tax funds through the state matching funds?
So the state gas tax is actually distributed to local agencies for their own use, so a portion of that. And then another portion of the state gas tax then goes into the state highway account, which then supports various transportation programs such as the STIP, the SHOP, State Highway Operations Program, which is Caltrans account for repairing and rehabilitating.
It is not, it doesn't come to Sandag for our project.
If the dollars are, the portion of the dollars that goes to the STIP would come to us.
Okay, thank you.
Yes. Any other questions on this one? Okay, so we wanted to show the range of all of the different revenues that we anticipate. Now, in the near term, you can see that there's, sort of sharp peaks and valleys, and really what that means is the infusion of these one-time either bond proceeds or loans that we have. So, for example, in the near term, we have about 2020 or so, there's a sharp mountain, if you want to call it, and that's the TIFIA loan. That's when we would draw down the TIFIA funds. Looking into the future, this section here, this rise that you see here, this would account for some of those voter approved initiatives or legislative approved initiatives. And then looking into the future, you can see that the ranges that we've applied, the high and low ranges that we've applied to some of the more uncertain fund sources are included in this forecast as well. Now, moving on to costs. So what we provided, there's 3 different columns here. And the first one is the costs that were included in the plan of finance that was approved a year ago in January. And then the middle column shows the cost estimate that was provided back in December. The 2 program costs are different in terms of the methodology. The first one was using the old ordinance estimates and escalating them. The second one was using the RTP cost estimates. And then the last one is what we would be including as part of this year's update. You'll notice that between what was presented in December and now, it goes down a little bit, about 400 million. The main reason for that is that as we move into the future, we're actually completing projects, and so those projects are taken off the plan of finance. So
it also, that doesn't make sense. It goes down more than 400 million because it goes back 3 years. Look at the dates up there. So it looks as if you're.
I think.
You see what I'm saying?
Yes. No. And actually, I'm glad you caught that because this number here should not be 2020.
Yeah.
Okay. Then that one should be 2017.
In the report, it's correct.
Yeah, in the report, it's correct.
Okay.
Sorry about that.
Yeah.
So, but thank you for catching up. And then one of the other things that we also look at is the long-term escalation rate. So, as I mentioned, we have the remaining projects. So, we're looking into the future. We're using year of expenditure dollars. We need to be able to escalate the costs as we know them today into the future. And so what factor should we use? So we work with Ray and his team, and there's a publication called the Engineering News Record, which tracks construction costs, and they have an index of the construction costs. And so what we do is we look at the 10-year average of the rise in the construction costs, and as we move into the future, it's a rolling 10-year average. So we just look at the last 10 years to adjust. A year ago, we used 2.8% as the long-term escalation rate. The one that was used in December was 2.69%. And then looking into the future, we have a range. Again, we'll probably use that same 2.69%, but we do want to note that there is some uncertainty as to where we're going to be. All right, almost done. So debt service and loans. The plan of finance a year ago included $5.9 billion in debt service. I just want to point out that some of that debt service is not associated with Transnet, some of that debt service would be paid back with federal funds or with other financing proceeds. So when I mentioned, for example, the grant anticipation notes, that would be included here. At this time, since we haven't run the plan of finance, I don't have a number yet, but that would be part of the information that we would provide with the plan of finance in a month. So next steps are to take the same report, probably in more abbreviated form, to the Transportation Committee, March 17th, and then next month to bring you the results of the plan of finance to this committee, the Transportation Committee, and to the board. With that,
would you go back 2 slides, please?
yes.
One more.
Sure.
Okay, if you're going to use on the far right-hand side, if you're going to use a range of percent increases, escalation, I think you should give a range of the cost, 22.2 billion
Okay.
to whatever.
Good point. Thank you.
Enough said. And so we're going to see this thing at our next meeting.
So what you're going to see, you're not going to see necessarily the assumptions, you're going to see the results. And so the results would include things like, are there any opportunities? Are there any, or should we stay the course on the early action program? Or, you know, in previous years, we've had instances where we had to slow down a little bit because revenues were coming in lower than anticipated, or whatever the case may have been. So those are the kinds of things that the plan of finance provides. So that's what we would bring.
Thank you.
It's up to you, Boyd.
So I have 2 comments/questions. You know, going back to Ray's 7-point plan, item 6, enhanced transparency. I would suggest including some version of this on an annual basis as part of that, enhancing the transparency and focusing people's attention on the underlying assumptions that go into the plan of finance, just for your consideration. Because I think this is tremendously valuable, I think, to give.
You know, like I mentioned in the past, we've included, several pages of assumptions.
Right.
But they were higher level and did not include some of these charts and things like that. So, you know, moving forward, you know, we would provide that sort of thing.
So the other question I had is, if you can go back to the revenue page where you show the range, if you know the chart that I'm referring to.
I think so.
This one?
Yeah. So just as a consumer of this presentation, I have to say that I would include what you're referring to as new fund sources as part of the high end of the range. In other words, the way I would think of this information is that the red line and the lighter orange line really speak to confidence levels of what's higher confidence, and that the line above, the high end of the range, is kind of like a more uncertain, I think, as you were characterizing. And I have to say, I mean, with total understanding that there are histories of new fund sources popping up, et cetera, it just seems that you'd have to almost discount those things so much so that I would think of them as really being part of the high end of the range and not, things to count on in the higher confidence level.
So maybe have like instead of having just a single line, maybe have like bands of the
well,
various
however you'd want to graphically represent it. Again, and I don't know, other people may disagree. I'm just giving you my own perspective, and also, like in the corporate world, when we do budgeting and we would have basically a to be determined bucket. The way I think about it, it's almost by definition that has to be included in the highly uncertain kind of category. So maybe, again, just something to think about. I don't know how the Sandag board thinks of that. As I mentioned the other day when we talked about it, to really highlight that there is a non-trivial amount of monies that are to be determined. I just feel like every time you reference the total revenues, you just always have to be illustrating the caveat that there is some non-trivial portion that is kind of a TBD. Because otherwise, it's too easy just, and some people might just go right to the summary of revenue assumptions and assume it like it's a given.
Yeah.
And there's just got to be a lot of uncertainty around that. So, that's my 2 cents. Anything else?
So is this?
John?
I have another subject.
Oh, okay.
A brief subject.
Relating to this or?
No, not related.
Okay. But I have to say, thank you for doing this. I think this is really helpful.
No,
Is
it's
this
excellent.
what you had in mind, kind of breaking apart the assumptions from the plan of finance, and doing a presentation like this first?
Well, again, absolutely, because I think it gives the, first of all, it gives more time to just talk about the key components of where the plan of finance is coming from, and going back to, again, the 7-point plan, as far as transparency, at least in my mind, I think this really hits that right on the, the nail on the head by giving us the transparency. So maybe in the future it doesn't have to be quite as granular, but it's very helpful.
Your colors are so pretty.
I don't know, does there anybody else feel like this is this overdoing it, or is this?
I don't know, this so far ahead that I think it's a good presentation, and I like the range. It doesn't bother me how you include that.
Well, and just to kind of, so the plan of finance, like I said at the beginning, has those 2 time periods: the short term, 5 to 7 years, and then the remainder of the years.
Right.
And so one of the things that we really focus on is how are we doing in that near term period?
That's right.
To identify any potential opportunities to advance more projects. Beyond that, we all understand that there's uncertainty, there's potential new fund sources, recessions, whatever may happen. And so as we move into the future, we start taking one year at a time. Right?
I hear points fine.
Now I just have one, this is really funny. I suggest that both your presentation and handouts and Ray's be kept so that when you have new members on the ITAC, it's a wonderful training tool to explain how this whole thing works and what all this stuff means. Otherwise, somebody who comes in after me is probably going to say, holy cow, what did I let myself in for?
I certainly agree with that. These would be wonderful as part of an orientation. Absolutely. Anything else? You had to set.
If we're finished with this subject,
Thank
I'd
you
like
guys
to
so
take
much.
less than a minute to go back to item number 5B in the MTS. I think that our chairman made a very astute statement at the end, after he voted, in which he said that any successes, any reductions in liability for the pension fund for MTS should not be used as a reason in the calculations to exceed their increases above CPI, et cetera, et cetera. I don't know how you exactly phrased it. And I would like to request or suggest that statement be memorialized in the minutes. Does that make sense to you? If we're going to take the pension fund out, when it increases the liability, we shouldn't let them use that as a profit making to exceed the CPI. Is that basically what you said, Stuart?
Yeah, it's sort of, you can't just have it one way.
You can't have it one way. And this is a year from now that we'll look at this again, but I think it was a great statement. I hadn't thought of it until after we closed the subject. And I'd just like to see a statement in there that Mr. Halpern stated that they should not use profits. You get my message?
Yes. And we were planning on including that in the report going to the board, the transportation committee rather.
Okay, well, since he said his one, my one for abstaining is this. I feel that if you are doing an accounting of somebody's finances, you include everything, because otherwise it's not real. You're saying, gee, I don't like this figure or that figure, so let's just not consider that. So I want somebody to know why I abstain.
I agree completely. I hate the liabilities of a pension fund in the state of California. But you that completes my comments.
Yeah, you know, I sort of jokingly made a comment when we first talked about it. With the 70% hurdle rate, I suspect there'll be fewer instances of exceeding it than there will be of excluding the cost, but we'll just have to see how that goes.
But if they do exceed it, they shouldn't treat that as profits to go out and be inefficient in their operations. Thank you very much.
So that's our meeting.
Good meeting.
April 12th is the next one. I don't know if people can comment on their expectations, just so you know.
I'll be here.
But, great.
All right.
Okay, thanks, everybody.
Thank you very much.
And especially Ray, thank you.
Oh, you're very
for
welcome.
all that. That was great. And Jose.
Oh, you're
appreciate
very
your
welcome.
support.